Index. Anand Shah is head of PMS and AIF investments at ICICI Pru Asset Management Company. He's a market master of the day. Anand, good morning. Good to have you with us here. Thanks very much. Banks have been consolidating. Yesterday, a flurry of activity, new high. In your opinion, are we likely to see a fresh, meaningful expansion on the upside, led by private financials this time?
Hi, very good morning. Yeah, I think valuations were reasonable. We've been seeing quite a lot of euphoria in various segments of the market, but one area which was particularly the private banking had sort of been a laggard. Valuations were reasonable, and overall, market sentiment made sure that this undervalued or the so-called reasonable valued stocks are also now getting a late look, but they're getting a look from the investors.
Right. Well, for now, there is a lot happening in the market. So the headline index may not, really indicate the kind of traction. It's flat with a bit of a positive bias. But look at individual stocks. M&M is your top nifty gainer right now. We were talking about that facelift version of the XUV 300. And the pricing is very competitive, actually. It's starting at 7 lakhs all the way to about 15 lakhs. And this space is hotting up, right? I mean, you have so many UV launches. The market share, this entire compact SUV space now constitutes about 50% of the UV volumes totally. And there are large players like Tata Motors, etc. in this space as well. Anand, welcome to the show. Consumption is booming, especially in the high end of the market, right? The premium side of the market. Do you think names like M&M, Tata Motors deserve to trade at these valuations? Or do you think that there could be more on the upside here?
No, it's a very interesting that you're saying consumption is booming, because obviously there is exactly opposite side. You have consumer companies which are complaining about the slowdown in rural consumption. So yes, this has been the story where there has been a K-shaped recovery. More so, if you see within consumption also, the consumption services have been picking up fairly strongly for us. We've been sort of looking at organized retailing. You touched upon trend just now. So those are the areas where people are gaining market share. So very clearly what is happening, you have select consumer stocks which are underperforming a lot, who are actually losing market share. At the same time, there are consumer-facing businesses which are gaining market share amidst inflation, which has been sort of a pain for consumer companies. They're still doing well. So it's more bottom-up. If you see market, as you rightly said, is not straightforward. It is at the levels where they're almost near all-time high. Valuations are no more as compelling as they were 3 years back, 4 years back. And to that extent, the way forward would be bottom-up, way forward would be stock picking. And within that, clearly market is in the mood to reward the market share gainers at the cost of market share losers.
Okay. Hi, Anand. Good morning and good to see you in. Anand, what about tech? I don't think it has too much of a weightage in your funds. At least that's what, I can see. Tell us, what kind of weightage do you look to increase it, given the kind of results that we saw? At times, it's a good place to hide, but the numbers have been fairly mixed out there. So what's your approach out there? Would you add it to the contra fund?
So again, look, most of the businesses, so there's a lot of things that have changed in the last 4 years. If you see prior to 2020, we were struggling to find businesses which would do well. We were struggling to find, especially outside consumer-facing businesses, who would have profit growth rate. They were all leveraged. Today, a large part of market is doing well. Over the last 4 years, we have seen a significant deleveraging among many leveraged businesses in manufacturing space in particular. And to that extent, the investors are spoiled for the choice, right? And that's where, obviously, IT businesses are great. They generate a lot of profit at a very high ROE. Over the last few years, they've been also rewarding investors with dividend and buybacks, paying out almost 80% plus of the profits to the shareholders. But the challenge is growth. The growth is challenged. And what happened in 2020, 2021, when we had a surge in IT spending by corporates at large globally, we also took the PE multiples for these businesses at a very high level. So I think what you're seeing over the last 18 to 24 months is more of a mean reversal of the PE multiples, more correction in line with what these companies can grow. And to that extent, yeah, it's a wait and watch for us. We've been sort of not owning IT for last 18 months. We're still looking to see what is the right time to own IT.
You know, a few of the names like Thermax is up. Some of the names which were not there in the mix in the morning, 4% on Thermax. There is stocks at what 46.35. HPL Electric is up 6%, and these got volumes, right? They're not going up on low volumes. There is CEAT, which is up 4%, 26.27. Maybe look at other tire companies as well. Spandana is up 3%. And Satin Credit Care is coming up with a 3% pop. Medanta is up about 3%. So yeah, it's expanding very fast. You know, the breadth of the move that we have right at the word go. Market breadth still 3:1 in favor of what's going up right now. Anand, you know, let's look ahead, right? What's the assuming there is political continuity? What's the, as most opinion polls are suggesting, that's it's a question of numbers if you go by them. What are we going to see the big focus on, in your opinion? Because government focus on key sectors has been a big sort of tailwind. It's helped with investment thesis. What to your mind is going to be top of the list?
Indeed, I think the trend is very clear. As a country, we've been a large consumer of goods, but not very large manufacturer of goods, and that is something which is changing. I think if you see last 4 years, inflation has been the theme globally because China is no more want to be the factory for the world or cannot be the factory for the world, and to that extent, somebody has to pick up the slack that will be left. As China lets go a lot of commodity and low end of manufacturing. I think we are, as a government and as a country, we are geared to get the manufacturing going in this country after a long time. And I think if you see the names of the companies that we discussed today in manufacturing allied, capital goods, these were something which were not discussed in 2020 or before that. They were almost lost decade for them. So I think we've just seen the early signs of recovery in manufacturing and the allied businesses. I think we have to see a lot. The private sector has deleveraged a lot. They have not really started the capex, and that's what the opportunity is. China +1, the Europe +1, and this is the right time when the corporates will actually start doing capex, not only for the domestic consumption, import substitution, but also for the exports. So I think we are very focused. Look, market is not cheap. These are not stories which are unknown, and to that extent, you'll have to be really bottom up. This is a wicket which is not batting wicket sort of a thing. It's tricky. It's a spinning wicket, and to that extent, stock picking will be important for last 4 years and next 4 years.
Okay, all right. We will leave it at that. Thanks a lot for joining in. Appreciate your time here on CNBC TV 18.